Question 1. Which of the following statements regarding open-end investment companies is true? A. They may issue common stock, preferred stock, and bonds. B. Their shares are traded on exchanges and in the over-the-counter market. C. They issue a fixed number of shares and do not redeem them. D. They may only issue common stock and must redeem their shares upon request. Answer: D. They may only issue common stock and must redeem their shares upon request. Open-end investment companies, commonly known as mutual funds, are characterized by their continuous offering of shares. They can only issue common stock, never preferred stock or bonds, and are obligated to redeem their shares at the current net asset value, NAV, upon an investor's request. This contrasts with closed-end funds, which issue a fixed number of shares that trade on exchanges. Understanding this fundamental difference is crucial for Series 6 candidates. Question 2. A customer invests $10,000 in a mutual fund with a front-end sales charge of 5%. If the net asset value, NAV, per share is $9.50, how many shares will the customer purchase? A. 950 shares. B. 1,000 shares. C. 994, 74 shares. D. 1,052, 63 shares. Answer: B. 1,000 shares. To determine the number of shares purchased, first calculate the sales charge, $10,000 * 5% equals $500. The amount invested in shares is then $10,000 to $500 equals $9,500. Finally, divide the invested amount by the NAV per share, $9,500 / $9.50 equals 1,000 shares. This demonstrates how a front-end sales charge reduces the actual capital invested, a key concept for understanding mutual fund costs. Question 3. All of the following are characteristics of a variable annuity except A. It offers a guaranteed fixed rate of return on investments. B. The investor assumes the investment risk. C. It is a security and regulated by the SEC. D. The payments into the annuity grow tax-deferred. Answer: A. It offers a guaranteed fixed rate of return on investments. A variable annuity allows the investor to choose how their premiums are invested, meaning the investor bears the investment risk. The separate account's performance is not guaranteed, therefore, it does not offer a guaranteed fixed rate of return. While variable annuities do typically offer a death benefit, guaranteeing at least the premium paid or highest account value, they do not guarantee investment returns. Variable annuities are considered securities due to their investment component and offer tax-deferred growth. It's important to distinguish between fixed and variable annuities regarding investment risk and guaranteed returns. Question 4. A registered representative is explaining different types of mutual fund share classes to a client. Which share class typically has no front-end sales charge but may have a contingent deferred sales charge, CD/SKI, and higher 12b(1) fees? A. Class A shares. B. Class B shares. C. Class C shares. D. Class D shares. Answer: B. Class B shares. Class B shares typically have no upfront sales charge but instead impose a contingent deferred sales charge, CD/SKI, if shares are redeemed within a certain period. They also generally carry higher 12b(1) fees compared to Class A shares. Class A shares have front-end sales charges and lower 12b(1) fees, while Class C shares often have a level load with no front-end or back-end charges, but the highest 12b(1) fees. Understanding the different fee structures is critical for determining suitability. Question 5. Which of the following investment products is not required to provide a prospectus to potential investors? A. Closed-end fund shares. B. Open-end investment company shares. C. Variable annuities. D. Exchange-traded funds, ETFs. Answer. A. Closed-end fund shares. While closed-end funds issue a prospectus during their initial public offering, IPO, once their shares begin trading in the secondary market, they are no longer required to provide a prospectus for subsequent purchases. Instead, they trade like common stocks on exchanges. Open-end funds, mutual funds, variable annuities, and ETFs, due to their continuous offering or unique structure, generally require ongoing prospectus delivery to investors. This distinction highlights the regulatory differences in how these products are sold and traded. Question 6. A mutual fund's net asset value, NAV, is calculated by A. Subtracting total liabilities from total assets and dividing by the number of shares outstanding. B. Adding total liabilities to total assets and dividing by the number of shares outstanding. C. Subtracting total liabilities from total assets and multiplying by the number of shares outstanding. D. Dividing total assets by total liabilities. Answer. A. Subtracting total liabilities from total assets and dividing by the number of shares outstanding. The net asset value, NAV, per share of a mutual fund is determined by taking the fund's total assets, subtracting its total liabilities, and then dividing the result by the number of outstanding shares. This calculation is performed daily, typically after market close, to establish the price at which investors can buy or redeem shares. Understanding NAV calculation is fundamental to comprehending mutual fund pricing. Question 7. Regarding the purchase of mutual fund shares, a breakpoint means A. A period during which an investor cannot redeem shares without a penalty. B. A specific dollar amount at which an investor qualifies for a reduced sales charge. C. The maximum sales charge allowed by FINRA. D. The point at which a fund's NAV reaches its highest historical value. Answer, B. A specific dollar amount at which an investor qualifies for a reduced sales charge. A breakpoint refers to a specific dollar amount of an investment in a mutual fund at which the sales charge is reduced. Funds offer breakpoints to incentivize larger investments, leading to a lower sales charge percentage for the investor. Registered representatives must inform clients about available breakpoints to avoid breakpoint violations, which are serious FINRA rule violations. This mechanism helps investors save on fees for substantial purchases. Question 8. A client has signed a letter of intent, LOI, to purchase mutual fund shares over a 13-month period. If the client fails to meet the commitment, what typically happens? A. The client's shares are automatically redeemed to cover the difference. B. The client loses the shares already purchased. C. The sales charge for previously purchased shares is adjusted upward to the appropriate level. D. The client is banned from future mutual fund purchases. Answer, C. The sales charge for previously purchased shares is adjusted upward to the appropriate level. If a client signs a letter of intent, LOI, to qualify for a breakpoint but fails to fulfill the commitment within the specified 13-month period, the sales charge on the shares already purchased will be retroactively adjusted to the higher rate applicable to the amount actually invested. The fund typically holds some of the initial shares in escrow to cover this potential adjustment. It's crucial for reps to explain LOI terms clearly to clients. Question 9. Which of the following best describes the primary objective of a money market fund? A. Long-term capital appreciation. B. Generating high income through speculative investments. C. Providing liquidity and stability of principal. D. Investing primarily in common stocks of blue-chip companies. Answer, C. Providing liquidity and stability of principal. Money market funds primarily aim to provide liquidity and stability of principal by investing in highly liquid, short-term debt instruments. While they offer some income, it's typically modest, and capital appreciation is not their objective. They are considered very low-risk investments, contrasting sharply with growth funds or high-yield bond funds. Their focus on safety and accessibility makes them popular for short-term cash management. Question 10. When opening a new account for a customer, all of the following information is essential for a registered representative to gather under FINRA suitability rules except A. Investment objectives. B. Financial status and needs. C. Risk tolerance. D. The customer's social security number for identification. Answer, D. The customer's social security number for identification. While a customer's social security number is required for tax reporting and identification purposes to open an account, it is not considered essential information for determining investment suitability under FINRA rules. Suitability requires understanding the client's investment objectives, financial situation and needs, and risk tolerance. The other options are directly related to assessing whether a particular investment strategy or product is appropriate for the client. This distinction is important for compliance. Question 11. A mutual fund may distribute all of the following to its shareholders except A. Dividends from investment income. B. Capital gains distributions. C. Stock splits. D. Tax-exempt interest. Answer, C. Stock splits. Mutual funds distribute dividends, from interest and dividends received on their portfolio investments, and capital gains, from selling securities at a profit, to their shareholders. Some funds may also distribute tax-exempt interest if they invest in municipal bonds. However, mutual funds do not typically conduct stock splits. Stock splits are actions taken by individual companies to increase the number of their outstanding shares, not by a mutual fund itself. This distinction is crucial for understanding mutual fund operations. Question 12. Which type of investment company issues shares that trade on an exchange, often at a discount or premium to their net asset value, NAV? A. Open-end fund. B. Unit Investment Trust, UIT. C. Closed-end fund. D. Face amount certificate company. Answer, C. Closed-end fund. Closed-end funds issue a fixed number of shares that are traded on stock exchanges or in the over-the-counter market, similar to individual stocks. Because their price is determined by supply and demand in the secondary market, their market price can fluctuate above, premium, or below, discount, their net asset value, NAV. This characteristic distinguishes them from open-end funds, which always trade at their NAV. Understanding this trading mechanism is key for Series 6 candidates. Question 13. A registered representative discusses the benefits of a variable annuity with a client. The client is concerned about outliving their retirement savings. Which feature of a variable annuity directly addresses this concern? A. Tax-deferred growth. B. Investment diversification. C. A death benefit provision. D. An annuitization option offering lifetime income. Answer, D. An annuitization option offering lifetime income. The annuitization option of a variable annuity allows the client to convert their accumulated value into a stream of periodic payments, which can be structured to provide income for life. This feature directly addresses the concern of outliving retirement savings, known as longevity risk. While tax-deferred growth, diversification, and death benefits are also features, they do not directly guarantee income for life in the same way annuitization does. This is a critical benefit for retirement planning. Question 14. Under FINRA rules, when must a principal approve a new mutual fund account? A. Before the initial purchase is made. B. Within 30 days of the first transaction. C. Promptly after the initial transaction, but not necessarily before. D. Only if the account involves options trading. Answer, C. Promptly after the initial transaction, but not necessarily before. FINRA rules require that a principal promptly review and approve new accounts after the initial transaction. While it's best practice for the principal to be involved early, the rule does not mandate approval before the first trade, as it might for options accounts. This ensures that the account opening process and initial transactions adhere to firm policies and regulatory requirements. Understanding the timing of principal approval is important for compliance. Question 15. What is the primary purpose of a 12b-1 fee charged by a mutual fund? A. To cover the fund's portfolio management expenses. B. To pay for distribution and marketing costs. C. To compensate the custodian bank for safeguarding assets. D. To cover shareholder redemption fees. Answer, B. To pay for distribution and marketing costs. A 12b-1 fee is an annual fee charged by a mutual fund to cover its marketing and distribution expenses, such as advertising, prospectuses, and commissions paid to brokers for selling the fund. This fee is deducted directly from the fund's assets and is capped by FINRA regulations. It's distinct from management fees, which cover portfolio management, or administrative fees. Recognizing the purpose of 12b-1 fees helps investors understand the total cost of ownership. Question 16. Which of the following is typically a characteristic of a unit investment trust, UIT? A. Actively managed portfolio of securities. B. A fixed portfolio of securities, generally with a termination date. C. Shares that trade on an exchange based on supply and demand. D. Continuous offering and redemption of shares at NAV. Answer, B. A fixed portfolio of securities, generally with a termination date. A unit investment trust, UIT, typically features a fixed, unmanaged portfolio of securities, often with a specified termination date. Once the portfolio is established, it generally remains unchanged, minimizing management fees. This differs from actively managed mutual funds and closed-end funds that trade on exchanges. UITs issue redeemable shares representing an undivided interest in the portfolio, similar to mutual funds, but without active management. This structure offers transparency regarding holdings. Question 17. Under the Investment Company Act of 1940, what is the minimum asset value an investment company must have before it can make a public offering? A. $50,000. B. $100,000. C. $500,000. D. $1 million. Answer, B. $100,000. The Investment Company Act of 1940 mandates that an investment company must have a minimum net worth of $100,000 before it can make a public offering of its shares. This requirement ensures that new funds have a basic level of financial stability before soliciting investments from the public. It's a regulatory safeguard designed to protect investors. This foundational rule is important for understanding investment company formation. Question 18. All of the following are typically considered suitable investments for a client seeking current income except A. High-yield corporate bonds. B. Utility stock dividends. C. Growth mutual funds. D. Preferred stock dividends. Answer, C. Growth mutual funds. Growth mutual funds primarily aim for long-term capital appreciation, meaning they invest in companies expected to grow rapidly, often reinvesting their earnings rather than paying high dividends. Therefore, they are generally not suitable for clients whose primary objective is current income. High-yield bonds, utility stock dividends, and preferred stock dividends are all income-generating investments. It's crucial for representatives to align investment recommendations with client objectives. Question 19. When recommending a variable annuity, a registered representative must ensure the client understands that the separate account A. offers a guaranteed rate of return. B. is insulated from market risk. C. is subject to market fluctuations and potential loss of principal. D. provides tax-free distributions. Answer: C. is subject to market fluctuations and potential loss of principal. The separate account of a variable annuity invests in underlying sub-accounts that hold securities, meaning its performance is directly tied to the market. Therefore, it is subject to market fluctuations and carries the risk of loss of principal. Unlike fixed annuities, there is no guaranteed rate of return, and the investor assumes the investment risk. Understanding this core characteristic is vital for proper disclosure and suitability. Question 20. What is the maximum sales charge percentage allowed by FINRA on the purchase of mutual fund shares? A. 5%. B. 25%. C. 5%. D. 5%. Answer: C. 5%. FINRA rules state that the maximum sales charge on mutual fund shares cannot exceed 5% of the offering price. This cap is in place to protect investors from excessive sales charges. Funds that impose the maximum 5% sales charge must also offer additional benefits like breakpoints and rights of accumulation. Knowledge of this regulatory limit is fundamental for Series 6 candidates. Question 21. Which of the following describes a breakpoint sale violation? A. Selling a mutual fund just before its ex-dividend date. B. Selling shares in an amount just below the dollar value that would qualify for a reduced sales charge. C. Selling shares to a customer who previously signed a letter of intent. D. Selling shares to a customer at the maximum allowed sales charge. Answer: B. Selling shares in an amount just below the dollar value that would qualify for a reduced sales charge. A breakpoint sale violation occurs when a registered representative sells mutual fund shares to a customer in an amount just below a breakpoint, thereby charging the customer a higher sales charge than they would have paid if they had invested slightly more to qualify for a reduced rate. This practice is prohibited by FINRA because it is not in the client's best interest. Representatives must always inform clients of available breakpoints. Question 22. In a Section 529 college savings plan, who assumes the investment risk? A. The state government that sponsors the plan. B. The financial institution managing the plan. C. The designated beneficiary. D. The account owner. Answer: D. The account owner. In a Section 529 college savings plan, the account owner, typically the parent or guardian, assumes the investment risk. The owner chooses the investment options, and the value of the account can fluctuate with market performance, similar to a mutual fund. The state sponsors the plan, and financial institutions manage the investments, but neither guarantees the returns. Understanding who bears the risk is crucial for advising clients on these education savings vehicles. Question 23. Dividends and capital gains distributions received from mutual funds are taxed as: A. Tax-exempt income. B. Ordinary income in all cases. C. qualified dividends or ordinary income for dividends, and short-term or long-term capital gains for capital gains distributions. D. Always as long-term capital gains. Answer, C. Qualified dividends or ordinary income for dividends, and short-term or long-term capital gains for capital gains distributions. Dividends received from mutual funds can be classified as qualified dividends, taxed at lower long-term capital gains rates, or ordinary income dividends, taxed at ordinary income rates, depending on the source. Capital gains distributions are taxed as either short-term or long-term capital gains, depending on how long the fund held the underlying securities. It's important to remember that distributions are taxable in the year received, regardless of whether they are reinvested. This tax treatment is a key consideration for investors. Question 24. Which of the following best describes the tax treatment of contributions to a Roth IRA? A. Contributions are tax-deductible, and qualified distributions are tax-free. B. Contributions are made with after-tax dollars, and qualified distributions are tax-free. C. Contributions are tax-deductible, but distributions are fully taxable. D. Contributions are made with after-tax dollars, and distributions are fully taxable. Answer, B. Contributions are made with after-tax dollars, and qualified distributions are tax-free. Contributions to a Roth IRA are made with after-tax dollars, meaning they are not tax-deductible. However, qualified distributions from a Roth IRA during retirement are entirely tax-free. This characteristic makes Roth IRAs attractive to individuals who expect to be in a higher tax bracket in retirement or who value tax-free income streams. Understanding the tax implications is critical for client recommendations. Question 25. A mutual fund's expense ratio represents A. The total sales charges incurred by the fund. B. The percentage of assets deducted annually to cover operating expenses. C. The difference between the fund's offering price and its NAV. D. The fund's return on investment over a given period. Answer, B. The percentage of assets deducted annually to cover operating expenses. A mutual fund's expense ratio is the percentage of a fund's total assets that are used to cover its operating expenses, such as management fees, administrative fees, and 12b-1 fees. It is expressed as an annual percentage. A lower expense ratio generally means more of an investor's money is working for them. This ratio is a critical factor for investors to consider when evaluating the overall cost of a mutual fund. Question 26. An investor who wants a variable annuity to start providing payments immediately should consider A. Deferred variable annuity. B. Immediate variable annuity. C. Fixed immediate annuity. D. Single premium variable annuity with a deferred payout. Answer, B. Immediate variable annuity. An immediate variable annuity is designed for individuals who want to convert a lump sum into a stream of income payments that begin almost immediately, typically within one payment period after the initial premium. In contrast, a deferred variable annuity allows the account to grow over time before annuitization. A fixed immediate annuity provides immediate payments at a guaranteed rate. Understanding the immediate versus deferred distinction is essential for matching the annuity product to a client's specific income needs. Question 27. All of the following are generally true about exchange-traded funds, ETFs, compared to open-end mutual funds except A. ETFs can be traded throughout the day on exchanges. B. ETFs prices are determined by supply and demand, not NAV. C. ETFs generally have lower expense ratios. D. ETFs must redeem their shares at NAV upon request. Answer, D. ETFs must redeem their shares at NAV upon request. ETFs, exchange-traded funds, trade like stocks on exchanges throughout the day, and their market price is determined by supply and demand, which can differ from their NAV. They often have lower expense ratios than actively managed mutual funds. However, unlike open-end mutual funds, ETFs are not obligated to redeem individual shares at NAV. Redemptions typically occur in large blocks by institutional investors, authorized participants. Retail investors buy and sell ETFs on the secondary market. This distinction is crucial for understanding how ETFs function. Question 28. When a mutual fund portfolio manager sells a security for more than its purchase price, this generates A. Interest income. B. Dividend income. C. Capital gains. D. Tax-exempt income. Answer, C. Capital gains. When a mutual fund portfolio manager sells a security for a higher price than what the fund paid for it, this generates a capital gain. These capital gains are then distributed to shareholders, typically once a year, and are taxable to the investor. Interest income is from bonds, and dividend income is from stocks. Understanding the source of investment returns is fundamental to analyzing mutual fund performance and tax implications. Question 29. Which of the following actions by a registered representative would be considered a prohibited practice or unethical behavior? A. Recommending a diversified portfolio based on a client's risk profile. B. Executing a trade in a customer's account without prior authorization. C. Informing a client about breakpoint discounts for mutual funds. D. Discussing general investment strategies with a client. Answer, B. Executing a trade in a customer's account without prior authorization. Executing a trade in a customer's account without their prior authorization is a serious violation of FINRA rules, known as unauthorized trading. A registered representative must have specific authorization from a customer before executing trades, unless the account is discretionary and proper documentation is in place. The other options describe appropriate and ethical actions for a registered representative. Question 30. A FINRA member firm must establish and maintain a system to supervise the activities of its registered representatives that is reasonably designed to achieve compliance with applicable securities laws and regulations. This system is known as A. The Supervisory Control System. B. The Internal Audit Department. C. The Compliance Oversight Committee. D. The Executive Management System. Answer. A. The Supervisory Control System. FINRA Rule 3110 requires member firms to establish and maintain a system to supervise the activities of their registered representatives that is reasonably designed to achieve compliance with applicable securities laws and regulations. This comprehensive framework is known as the Supervisory Control System. It includes written supervisory procedures, designation of principals, and regular inspections to ensure proper oversight of all business activities. Understanding this system is vital for regulatory compliance. Question 31. Which of the following fees is a component of a mutual fund's annual expense ratio? A. Front-end sales charge. B. Redemption fee. C. Management fee. D. Purchase fee. Answer, C. Management fee. A mutual fund's annual expense ratio includes ongoing operating expenses such as management fees, advisory fees, administrative fees, and 12b-1 distribution fees. Front-end sales charges, redemption fees, and purchase fees are transactional costs paid directly by the investor and are not part of the ongoing annual expense ratio. Question 32. An investor owns shares in a mutual fund and chooses to have all dividends and capital gains reinvested. For tax purposes, how are these reinvested distributions treated? A. They are tax-deferred until the shares are sold. B. They are tax-exempt, as no cash is received. C. They are still taxable in the year they are distributed, even if reinvested. D. They are only taxable if the investor is in a high tax bracket. Answer: C. They are still taxable in the year they are distributed, even if reinvested. Even when an investor chooses to reinvest dividends and capital gains distributions from a mutual fund, these distributions are still considered taxable events in the year they are received. The IRS treats reinvested distributions the same as if the investor received the cash and then used it to buy more shares. This means the investor may owe taxes on gains even if they don't receive cash in hand. Understanding this tax treatment is crucial for financial planning. Question 33. Which of the following is true regarding a qualified variable annuity compared to a non-qualified variable annuity? A. Qualified variable annuities are funded with after-tax dollars. B. Contributions to a qualified variable annuity are tax-deductible. C. Non-qualified variable annuities are typically offered in employer-sponsored retirement plans. D. Distributions from qualified variable annuities are entirely tax-free. Answer: B. Contributions to a qualified variable annuity are tax-deductible. Contributions to a qualified variable annuity are typically made with pre-tax dollars, meaning they are tax-deductible, and are generally offered within employer-sponsored retirement plans. Non-qualified variable annuities are funded with after-tax dollars, and their contributions are not tax-deductible. While growth in both is tax-deferred, distributions from qualified plans are fully taxable, both contributions and earnings, whereas only the earnings portion of non-qualified distributions is taxed. This distinction affects how the annuity is used for retirement planning. Question 34. A mutual fund's prospectus must disclose all of the following except: A. The fund's investment objectives and policies. B. The fund's expense ratio and all fees. C. The names and salaries of all portfolio managers. D. The fund's performance history. Answer: C. The names and salaries of all portfolio managers. A mutual fund's prospectus is a legal document that must disclose comprehensive information about the fund, including its investment objectives, policies, risks, all fees, like sales charges and the expense ratio, and performance history. However, it does not typically disclose the individual names and salaries of all portfolio managers. While the management team may be mentioned, specific salary details are not required. Knowing what must be in a prospectus is key for investor protection and compliance. Question 35. Which of the following types of securities are primarily held in a money market fund's portfolio? A. Long-term government bonds and blue-chip stocks. B. Highly speculative options and futures contracts. C. Short-term commercial paper, treasury bills, and certificates of deposit. D. Real estate investment trusts, REITs. Answer: C. Short-term commercial paper, treasury bills, and certificates of deposit. Money market funds primarily invest in highly liquid, short-term debt instruments such as commercial paper, treasury bills, T-bills, certificates of deposit, CDs, and repurchase agreements. These securities are characterized by their low risk and short maturities, which help the fund achieve its objective of principal stability and liquidity.